podcast, I have Imran Lakha here. He's got 20 years trading experience. He's also the founder and CEO of Options Insight. So we're going to dig in and learn about his trading background as well as some interesting stories he's learned along the way of trading and starting his own business. Imran, how are you doing?
Hey Greg, thanks for having me, man.
Absolutely. So we're super excited to have you on. I'd love to kind of get to know a little bit about your background. So you have a big presence on Twitter, you have a presence in the macro space and in the crypto option space. So how did you get started into trading, and like what's your career look like since the beginning?
Sure. So I started in 2001. I started at Credit Suisse in London in equity derivatives. And the year before, I'd actually been an intern on an FX spot desk at UBS. And within a matter of a few weeks, I realized I hated that, and spot was just not for me. So I very quickly sort of realized I wanted to get into derivatives and options because I was much more into the kind of more mathematical, quantitative side of things, right? It's just more intellectually stimulating, let's say. So then I applied various places, ended up at Credit Suisse, started my career there, spent about 6 years there, moved over to Merrill Lynch, courtesy of one of my bosses who kind of took me over there. And then traded through the financial crisis at Merrill Lynch, which was interesting, given that they ended up getting taken over. And then took a bit of a career break because, 10 years in the game, you get a bit burnt out in trading. And then came back to Citibank, ended up running the desk there for a little while, equity options again, equity index options. And then had a little short stint at Bluecrest on the buy side. And then set up on my own about 3-4 years ago in the education space, where I kind of developed a bit of a passion and a love for teaching people as well throughout the career, and realized that I wasn't bad at it. So I thought, why not make a business out of it? And that's what I do at Options Insight, basically.
Yeah, that's fantastic. So kind of jumping back here a little bit, you said you were at Merrill Lynch, you traded through the financial crisis. Merrill Lynch was bought by Bank of America, I believe, for those who don't know. So that must have been, pretty scary at the time on the desk as well as in the markets. Kind of what was your thinking in that time, and what kind of stuff did you see?
I mean, it was a very unique time. I mean, it was like something we'd never been through before, right? And it was like literally in the vol space, it was kind of the best trading environment we'd ever seen, right? Because that's when index option traders make the most money, right? When markets are melting down, the volatility is crazy, the vol's moving around, and there's liquidity to actually do trades. Because what happens is when markets move so fast, and most other asset classes just kind of seize up, like single stock options don't really trade, convertibles break, structured products break. It's just a mess everywhere. And the only liquid product that's actually still trading is index. And that was where we were. So we were really in the epicenter of that. And we also had some pretty smart desk heads and people like the head of businesses who were like quite, knew early on that this was getting a bit pear-shaped, who were warning us that you don't want to be caught short downside here. We could be in a very precarious spot. So we kind of had a bit of guidance that things were going to get a bit hairy. So we were able to position our books. Having said that, in bear markets like we're going through now, right, you get really violent short squeezes as well. So we had to come up with smart ways to structure our books to benefit from that volatility to the downside. But we had a blowout year that year, right? I mean, but the irony was, there was a risk that the bank was basically going bust, and we would have got paid nothing if that happened. So if Bank of America hadn't swooped in and taken them over, I would have got a big fat zero that year, even though I had my best year ever, right? So it was pretty crazy.
Yeah, that is crazy. So equity index options, that makes a lot of sense. People who are new to trading, like one of the strategies you have is you have a book of stocks and you want a quick hedge. Instead of hedging each individual position and doing hundreds of transactions, you can go ahead and just kind of hedge in one place on the index. So it makes sense that index vol had sort of the most liquidity. So when people are trading index vol, do they ever trade, call it S&P vol versus NASDAQ vol versus the Russell?
100%. 100%, yeah. There's a whole load of RV called relative value trading that goes on in the index space, right? So you typically have the S&P, which is your benchmark vol, and that the S&P vol surface is super liquid, super transparent. Everyone knows where it trades, and then every other index is kind of benchmarked to that, right? So you kind of know if Nasdaq's trading 5 vols over S&P, that might be a bit high. So you don't want to be buying too much of that there, right? And those spreads, as we call them, between the S&P and the other indices, they typically trade in certain ranges, right? And you'll know when it's expensive in the range or when it's cheap in the range. But then sometimes you get these regime shifts where the range will break and it will go to a new place where it's never been before in ages. But that's because something specific's happening, right? So you had that happen in Europe through the European sovereign debt crisis, where you might have had Euro stocks, which is let's call it the most liquid options market in Europe. The Euro stocks might have traded at 3 or 4 vols above S&P. That blew out to like 8 to 10 vols above S&P, right? When that crisis was going on. But then over time, things normalize and it goes back to kind of where it normally lives, right? So there's a hell of a lot of trading that goes on in that RV space, particularly in the hedge funds who trade volatility.
Yeah, oh, that's fascinating. And then another thing that's kind of interesting about indexes is that in kind of bearish panic markets, kind of stocks all fall together at once, and the underlying components of the index have this high correlation. And then in a bull market, some companies are doing well and some companies are going bankrupt, and you get a lot of diversification. So the concept of diversification exists in the normal times, bullish times, and in the down times, you kind of lose that diversification effect and have a lot of correlation. How does that affect you as an index vol trader? Is that something that you look at?
Yeah, so the way you measure that is through a measure called implied correlation, right? So you can do a calculation on the index vol relative to the weighted average of the component vols, and that you can imply a correlation measure, right? And the idea is that, again, that just like everything else, that correlation will live in a certain range, right? So if you take the S&P, typically people look at the top 50 S&P stocks versus the S&P index, and they work out an implied correlation, and that implied correlation might live at around 40 to 50%, basically, okay? But it might not always realize that. It might sometimes realize as low as 10 or 20%, or it might go as high as 80% in a crash, for example, when everything moves the same, right? So that implied correlation is something that index traders definitely need to keep an eye on, because it gives them a bit of a read on how much stress is being priced into the index vol relative to the constituents, basically.
Yeah, that's fascinating. And so you have both experience on the buy side and the sell side. Kind of sticking here with Merrill Lynch and we'll jump into Credit Suisse right after this. But what's kind of the structure as a trader on a desk at a big bank versus, call it, what you were doing at Blue Crest? Do you get to make your own decisions, or are you only responding to customer order flow? How does that sort of work?
It's a good question. I mean, back in the day, bear in mind, I started in 01, right? So 20 years ago, yeah, you had loads of autonomy, depending on your level of seniority and experience. As long as you were trusted by the guy running the desk, you could kind of go and trade whatever you want, right? And put on whatever positions you want, as long as you think you can make money out of them. As the years have gone by, as risk appetite in the banks has gone down through regulation and things like that, liquidity in the market in general has just gone down as well. There's less of an appetite. So you found a lot of the big risk takers in banks who used to make big money and get paid big money, they ended up being incentivized to move away and go to hedge funds and stuff like that. And the guys who were left were the kind of guys who just ran a tight ship, provided liquidity to clients, but didn't go out on a limb to take massive risk and take big positions, because A, the bank didn't like taking big risk, and B, even if you made loads of money, you weren't going to get paid that much for it, right? Because they were capping the amount that you could get paid and stuff. So that risk-taking mentality did change post-crisis, post-08 and stuff. And I think that's that trend has just kind of carried on as the years have gone by. And that's why you've seen a lot of talent, a lot of risk-taking talent leave a lot of the big banks, basically.
Yeah, that makes a lot of sense. And I guess for those who are curious, what is the pay structure like? When I was prop trading at some of these firms here in Chicago, typically the way that it works is you have sort of an annual benchmark that you got to meet, and after that you get to a straight profit split. So in the case of the firms I was at, it was 20 to 25%. Above that benchmark is a pure profit split. How does it work at a big bank? Is it similar?
Nothing like that. I mean, I wish it was like that. I'd be a much richer man than I am, yeah, if it was like that. But it's a function of how the whole business is doing, right? It's a function of the state of the market. It's a function of loads of things, right? Obviously, you need to make money. And if you've made more money than pretty much everyone else on the trading floor, you are going to get one of the better bonuses. But it kind of does depend on how the whole business does. And that bonus pool is very impacted by that, right? So, for example, like I said, 2008, I had my best year ever. Yet 2009, I made probably a third of what I made in 08, but I got paid more than double, right?
Yeah,
because 09 was a much better year for the world and the markets than it was in 08, basically, right? So you're very exposed as a bank trader, unlike hedge funds who are generally on a percentage cut, right? You have a prop desk. Banks are very exposed to the market environment in terms of how much you get paid.
Yeah, that makes a lot of sense. And I guess your boss has to like you because at the end of the day, it's a little bit discretionary to them.
Yeah, exactly.
So let's jump into Credit Suisse. So you said you're running the desk at Credit Suisse. Now,
no, I was started at Credit Suisse, but I ran the desk at Merrill and I ran the desk at Citi as well.
Citi, I'm sorry, Citi. So let's jump over to Citi. So how different is it, being on the desk versus running the desk? What are some of the things that you think about?
Oh, wow.
What keeps you up at night? Is there any rogue traders that you're always worried about?
It is pretty different. I mean, it's funny. Like, I was always the kind of trader who didn't really want to run a desk. I was quite happy to not get involved with the politics, go to loads of meetings. I just wanted to focus on the trading side and the making money side because that was the bit that I enjoyed and I thought I was good at. And I didn't want the other nonsense, right? But problem is, and again, this is partly a problem with the way banks are run, is that the more the kind of higher you start to produce in terms of money, to be able to pay you, people have to promote you to management. And then you do less trading and more management. So the reason they're promoting you is because you make money. But then once they promote you, you can't do the thing that you're good at, which is making money, because you spend half your day in meetings, right? So it's really badly run. It's just annoying. But I really enjoyed the managing down part of running a desk. I liked kind of motivating the troops, educating the troops, sort of, giving guidance and bouncing ideas around, and kind of that was really fun, right? I really enjoyed that. But the managing up I found really annoying and frustrating, basically, right? So for me, the managing up was always the harder part than the managing down, which is why even now, when I'm doing what I want to do, which is teaching, again, some of those skills that I had at managing down, I use when I teach, right? But the managing up was just not for me, really.
Yeah, that makes a lot of sense. And how big is a desk at one of these banks? Like, let's say the index option.
I mean, it varies, right, which bank, but you can have 3 or 4 people, or you can have maybe up to 8 people on like one of the desks. I mean, the business is, you could look at equity derivatives, obviously a much bigger, broader area, so you'll have way more people. But equity index options will be a handful of people, basically, right, nowadays. And nowadays, a lot of stuff's getting automated as well, right? So if you have automated market making systems and stuff like that, that's one less headcount you kind of need, right? So whereas you might have had 2 guys running a book, a junior and a senior, well, if you've got a computer that can do automated market making in any size under 1,000 lots, you don't need the junior anymore. You don't, right? So that's the kind of stuff that's been going on, and that's why banks have been in secular decline and have been laying off staff for years and years and years as that automation has been happening.
Yeah, that makes a lot of sense. And did you ever have an experience with sort of a rogue trader or someone who kind of was sneaky with their risk?
Yeah, I mean, I wouldn't call him necessarily a rogue trader, probably more of a stupid trader in terms of didn't understand the risks that were in his book and was just kind of very sort of stubborn and single-minded about it. But yeah, I definitely had a guy working under me once I gave him probably a little bit too much rope, and he ended up hanging himself and partially hanging me at the same time. Because, yeah, I mean, it's one of those things, if you give people too much trust and they don't actually deserve it, you kind of give them too much credit, basically, that can be quite dangerous, right? So you can't just assume that they're going to use their common sense and think the way you think. You have to make sure that is actually what they do, right? And so that's why sometimes the better managers are the ones who necessarily don't spend their time thinking about markets and the big chip picture and trading, but they spend all day long kind of looking under the hood in other people's books to check that there's no skeletons in the closet, because they want to make sure everyone's like doing what they say they're doing, and they're not hiding anything, basically, right? So we didn't have any massive debacles like some of the other banks. Like I think SocGen had a guy who lost billions, and there's been various scandals, right, where certain banks have had guys who lost numbers in the billion. We didn't have any of that, but certainly I had a guy working for me who was not helpful in that regard, and was kind of putting on too many positions in the same direction, and even though it was going against him, he was like, you know, messing about with the marks, and it just wasn't really the way you should be running a book, right? Like the best way to run a book and the best way to trade is to just be completely honest and transparent about your book, and remark your book correctly every day. Be honest about whether you made or lost money, and take the hit if you're down, take the hit every day. If you're up, show the P&L, because then you can be intellectually honest about your decision making, right? And also, you know, if you're losing money 5 days in a row and it's trending against you, if you feel that pain of losing the money every day, you're more likely to cut some of it, to cut some of the losses. If you just kind of, you know, ignore it for 2 weeks and you don't actually keep an eye on how much you're losing, then it's just going to snowball and get worse and worse and worse. And you're going to end up running a losing position. And when it does finally come to bite you, it could destroy your whole year, basically, right? So I think, you know, I've always been a believer in just marking the book correctly, and that kind of helps you risk manage, basically.
Yeah, that makes a lot of sense. Absolutely. And let's go ahead and jump over to Bluecrest. Is Bluecrest a hedge fund, or is it a prop desk? And what was your experience like?
It's a hedge fund, but I think it turned into a family office by the time I got there, right? So they gave back a lot of investor money, and it was just Mike Platt's money. He's the... you know, my experience of Bluecrest, I mean, I won't go into too much detail, right? But it was very different, right? When you're on the prop side, you're not overwhelmed. Like I was under the impression, you know, you would be overwhelmed with information, basically, right? Because that's what it was like at the banks. And I thought, if I'm at a fund, then every bank's going to be giving me all of their information, and I'm just going to be overwhelmed with ideas, and I just need to cherry pick the ones that I like, and it's going to be easy, right? The reality is, like, if I was Mike Platt, that might be true, right? Because everyone's bending over backwards to get business from the big boys who run a yard, which is $1 billion, right? That's the slang for a billion, right? But when you're a small PM at a fund just starting out, no one really cares about your flow, because your flow is so small, right? Because you don't run enough capital to be relevant, right? So because they don't really care about your flow and your business that much, you don't get all the ideas and you don't get all the information being thrown at you. And actually what happens is, by the time the information gets to you, it's old and stale information, and it's not very useful, right? So what you actually have to do is you have to plug yourself into the right places that give you the information in real time, and build that network of real-time information by people that you trust in the various banks, salespeople that you have some rapport with, who like you, who know you, that sort of thing. And then you can utilize and access that bank information that's out there to be able to make real-time decisions and actually have some edge. But I actually sort of massively overestimated the edge that you would have just naturally sitting there at a fund. And also, if you're kind of siloed and you're not part of a pod that is privy to all that real-time information, then you're quite isolated, basically, right? So I underestimated how much I benefited from the information flow that was coming on a trading floor, and on the buy side, it was just totally different to that. It was a complete contrast to that, basically.
Yeah, wow, that's fascinating. And so, you know, this is a pretty extensive trading career. You've seen a lot. What are some of the kind of lessons that you learned along the way for your own trading? You know, what are some of these things that you carry forward to this day to help your P&L?
Yeah, I mean, the things that kind of stick in my mind are just, don't get too big in a position, right? Don't get overconfident. There's a risk of, when you're making a bit of money and you're doing quite well, you just think every trade you do is going to be a winner, right? And you want to get bigger and bigger and bigger and make more and more cash. And generally, whenever I've got too big, I've definitely lost money, right? So you kind of remember that, right? Now, what tends to happen, the right way to get big is to do it via convexity, basically, right? So if you have option positions that start off quite small, but they have explosiveness in their nature because they're low delta options that become high delta options, and you've kind of let them run and the position's grown naturally by itself, that's the way to get big, basically, right? You don't start big, you put positions on that can become big if they go right, and then you monetize them when they get big, right? And those are the times where I've really cleaned up and had my best years, where I haven't started off just going all in, but I've put on smart trades and I've kind of let them grow themselves and run them, and then that's worked quite well.
That's fantastic. So that's typically a huge sticking point for traders, that ability to hold. And so like the fact that you're able to hold sort of these, low probability trades that become at the money, in the money, gain all this value, and you're still holding it, that's a hard thing to do. That's a lot of skill. So that's great.
Yeah, but you take a few chips off along the way, but you got to remember why you got into the game, why you got into the trade in the first place, right? So you don't want to take too much off, because like I say, that's where you make your money, in those few trades that you run for a long period of time. That's often where you make a large percentage of your P&L, right? And then the flip side of that is cutting your losses, right? So the phrase that always sticks in my mind is the first cut is always the cheapest, right? So don't be afraid to make cuts, and frequent cuts, because you are gonna do trades that lose money, right? It's the trick is keeping those losses relatively in check and relatively small, and not letting them snowball against you, right? And that's a hard thing, right? Because people just don't like taking losses, right? So you've got to just get used to taking loads and loads of small losses and be agnostic to small losses, and then once you do that, that also encourages you to let the winners run, because you're saying, I can handle taking 3 or 4 losses, because if I get one winner, because I'm letting those winners run, it's going to cover me, basically, right? So you've got to have that mindset of making big on the winners and keeping the losses down to small. And then the last thing I've learned, or not, I'm sure I've learned a lot more than this, but just thing that sticks in my head and is liquidity can evaporate in a heartbeat, basically, right? So you might be in a market environment where you've got a ton of liquidity and you're able to do really large trades, and clients have put you into positions and they're huge positions, and you can get out of them, right? Because there's liquidity there. Problem is, in a month, the world could change and that liquidity might go to zero, right? And it's like, so that's why you've got to be really on top of that and have a good sense for that, and not just blindly think that liquidity is always going to be there, basically. Because I made that mistake in 2010, right before the sovereign debt crisis, when Greece got into trouble and needed bailing out in Europe, and liquidity literally from March 2010 to May 2010, I mean, it just completely disappeared. I was trading the most ridiculous size in March. I couldn't trade a thing in May, right? And it was, and I was stuck with some really big positions that just completely annihilated me. And that's a lesson that I learned forever, basically.
Yeah, that's fantastic. On that point, there's a story kind of that went around on our desks over in Chicago, was on the Brexit event. We're trading a lot of spreads that mean revert. And on the Brexit event, there's this trader who was fading the spread, and the spread just never came back. It's something that's maybe a 10 point wide spread went to 120 points and ended up losing 4 years of previous P&L, and that was it. So that's one of those things where that environment, like you're explaining, Brexit, some sort of unforeseen event can really change all the dynamics of the markets, and things that would do mean reversion in the past just start to trend and never come back. So that's quite interesting. Do you have any stories like that you've experienced on some of the desks over the years?
Stories. I mean, I had some pretty cool. Well, I had some big wins in 2008, which will always stick in my mind.
Yeah, how about those?
The moves that we were seeing in 2008, like in October. Obviously, the Lehman's bankruptcy happened in September 2008, right? And obviously things were crazy in September, but in October is when the real liquidation event happened, right? And the market just melted, okay? And me and my boss, right, basically we were the two senior guys on the desk, and we couldn't believe what was happening around us. And in the space of 1 week, we had 2 days in that 1 week where we made more than $50 million in a day, right? So normally, if you make $50 million in a year, you're a hero, right? Like, that's an amazing year, right? In 1 week, we had 2 days where we did that in a day, and we were looking at each other going, is this really happening? Like, it was crazy. But now the other desks all around the floor were like dropping like flies, right? Like losing 100 there, 100 there. I mean, the numbers just were amplified by like a factor of, 10 or 100 even in some cases, right? So, but that's just, that would always stick in my memory. Like, it was just so funny that those were the kind of numbers that were happening.
Yeah, it's amazing.
But then on the flip side of that, losses wise, 2010, like I say, was a tough year. My worst day in 2010 in the summer was like, I was down 13 million in a day. And I was like, and I was there till 2 a.m. writing a post-mortem email to like the global head to explain why. So that was an interesting time. Thankfully, it still wasn't bigger than my 2008 gains. So I was still net well in the positive territory. But let's just say that they didn't exactly appreciate losing that kind of money in a day.
Yeah, those are emotional swings for sure. Sweating bullets, I could totally feel it. Cool.
Well, I've got one more story, which is quite funny, which was the Trump election, right? So the Trump election, where he became president, like the market was pricing 80-90% odds that Hillary was going to win. And I was convinced that Trump was going to win. So I don't know what you thought. I'd be interested to know, actually, right? But I was convinced Trump was going to win. And that's because I had some people with their ears to the ground in the US who weren't just mainstream media monkeys. They were like, they kind of knew what the scoop was, right? They knew the realities on the ground. They knew that a lot of people wouldn't admit to voting for Trump, but were going to vote for Trump and that type of stuff, right? And Trump was like the vote for change, right? And people just weren't happy with the status quo. So there was a much higher odds than the market was pricing. So I was set up short. All the analysts in the bank were saying, yeah, if Trump comes in, the market's going to be down 10%. It's going to be a shit show, blah, blah, blah. And no one on the desk no one on the floor believed me, but my desk all agreed, right? We collectively agreed that Trump's probably going to take it, right? So we came in short. We come in the morning, market's down 5%. We're up like over $1 million, high-fiving. We're like saying, I told you so to everyone on the floor, okay, because we called it and we're up money. But we're like, market's only down 5%. Surely when the US comes in, it's going to drop another 5, right? Because that's what all the analysts think. The analysts think that this is a shit show. And when the US come in, they're going to have to dump it and it's going to make us even more money. So by the time the US comes in, the market's recovered to unched on the day because Trump gives his like acceptance speech and sounds presidential or whatever. And then the bond market suddenly decides that it's not a bad thing and he's going to do all this spending and stuff like that. So basically, the market completely recovers, reverses. I take no profit because I'm a stubborn idiot, right? And I give all the money back. I go from being up $1 million on the day to being down $500,000, right? And all the people on the floor who had no clue that Trump was going to win end up making a load of money, yeah? So I end up being down on the day, having called it. And then everyone else who was clueless ended up just luckily making money in their positions. It was hilarious.
That's so interesting. Yeah, because not only that, but in the next couple of years were this huge vol crush, and we saw those VIX ETPs and stuff like that. That was one of the best, 2017 and 2018 until the Volmageddon were very good sell vol years, which is super surprising. Yeah, I remember trading that night actually myself. And
did you?
Yeah, and so I was leaning kind of bearish, and then everything came back, and I was like, "Uh-oh, this is not what I think it's gonna happen," and it ended up being like a super bullish environment. And
yeah, market just went to the moon from there, right? It was amazing.
Moon. Yeah, super fascinating. So, kind of moving now to you're running your own business. So, how is running your own business kind of different than a trading career? I know that for me, I've seen a lot of kind of things that are very different. One of the big things is in trading, you're rewarded for being patient and not doing anything. And in running a business, you're basically dying if you're not moving forward. And what are some of the differences that you've noticed in running your own business? And We'll
It's a good
kind of jump
question.
into options insight.
Yeah, I mean, I think there's some similarities to trading. There's clearly differences, but I mean, from my experience, it's made me realize that I've got more skills than just trading, right? So it's forced me to engage with other skills, right? So whether it's networking, whether it's some creativity, like there's things I never really practiced, right? So I didn't know if I was any good at them, right? But being more creative and that sort of thing, and like networking like crazy. I mean, generally traders don't network, right? Salespeople network. Traders just trade, and they rely on salespeople to do the networking and see clients and all that stuff. But if you're going to run a business and you don't network, you ain't going to go anywhere, right? Like literally, my whole business has been built on collaborations and things like that, right? That's how you get known. That's how you get opportunities. That's how you get business and clients and exposure, right? So that's been a big thing I've had to do and learn how to do. But I literally had no LinkedIn, no Twitter, nothing when I was in the banks. Most of my colleagues and friends who are still in banks have no social media presence. I've had to have a social media presence, and I've learned to do that. And I'm now I enjoy it. I never knew I would enjoy it, but now I do enjoy it because I get some positive reinforcement because people seem to engage with my posts and my tweets, and they like the education that I provide and stuff like that. So then you actually feel like tweeting more. Like I used to think, why the hell would I ever do a tweet? Like who gives a shit what I have to say, right? And now it's like I tweet something and 30 people respond to it. It's like, okay, maybe someone does care what I have to say, so I'll say some more. Yeah. So that was kind of the positive reinforcement I got. But yeah, I agree with you about moving forward. Like you got to keep plugging away, and you got to be very self-motivated, and you have to have that drive within you to push a business forward. And I think the only way you can do that is if you love what you do. Right? If you have a genuine passion for what you're building and what you're doing, then you'll have the staying power to get through the tough times, right? And if you're kind of not that bothered about what you're doing, then the chances are whenever you go, because you'll always go through tough times in business, right? It just has ups and downs, right? It has waves. And when you go through one of those down waves, if you don't genuinely love what you're doing, you're just going to give up and go and get a day job, right? That's what I think.
Yeah, that's a great point. Absolutely, the passion is really, it's got to be there. So let's talk about options insight. You mentioned that there's a boot camp coming on board. What is options insight, and what does something like a boot camp look like?
Yeah, so the whole sort of reason for founding Options Insight was I knew how to break down options theory and trading and how to really trade options from a practical perspective in layman's terms, right? And really, it's not rocket science. I was convinced I could teach it to a monkey, right? And really just explain how these things work and kind of, just sort of demystify it a little bit, basically, right? So that was the goal, and that was the idea. So there's been various iterations of my courses and my boot camps, but now we've basically landed on, I run a weekend boot camp, which lasts 6 hours a day, Saturday and Sunday. Every few months, I run one of these boot camps, and they're open to anyone on the planet. They're virtual, they're on Zoom. We have anywhere between 10 and 30 people in them, yeah? And people can come. It's an interactive class. I've built a syllabus now that covers, a lot of options, sort of foundational options knowledge, from, the basics, the payoffs, combined option payoffs, skew, term structure, portfolio hedging techniques, VIX products, what else have the Greeks, what they mean, the profiles, how to think about it, all those things, right? So the boot camps cover quite a lot of material. They're quite intensive. But the idea was you cram a lot of intensive material into 2 days. That doesn't make someone a professional options trader, but they get exposed to a hell of a lot of content. And then I have an ongoing service that is not the boot camp, but which is my subscription service, which is called Macro Insight, which is where people get continuous interaction with me. And I narrate what is going on in macro markets across all asset classes. I talk about how I'm trading, because I am still trading my own cash to stay actively engaged with markets. I talk about how I'm using options, how I'm thinking about the setups, what trades make sense, what trades don't make sense. I also do crypto, obviously, as you know. And the idea is if you've been to one of my boot camps, then the next stage is to come onto Macro Insight, which you also get free 1 month access to. But the idea is you stay on after that 1 month and you you practice the skills and the knowledge that you learn in the boot camps alongside me, and I can kind of hold your hand through that process, and you get to actually see how the pros trade, right? And how you use options sensibly, correctly, and you can kind of, I like to say, I like to empower people to embrace volatility rather than be scared by volatility, right? And if you don't know what options are, normally volatility is a scary concept for you, basically. Yeah.
Yeah, that's awesome. And that sounds like a type of thing that prevents a newer trader from making a lot of expensive mistakes and gets to, consistent profits a lot more quickly by finding, things that they can do repeatedly and have good systems in place and habits.
Exactly. Avoiding mistakes is the key, right? You'd rather someone spent, a grand or two on this course to prevent them dropping 20 grand in their account, basically, right? That's the idea, right? It's just kind of, and it's not like I'm going to give you the holy grail of how to make money all the time, right? But the course will teach you how to think about this stuff, right? And you'll then be able to identify your own edge, right? Where your edge lies and the type of trades that work for you and that make sense for you, and you're comfortable, the risks that you're comfortable taking, whether you're like a carry guy who likes to earn theta and harvest that risk premium, or whether you're a directional guy who likes to use options for leverage to play your views. There's all sorts of styles that you can have as an options trader, and this is going to hopefully enlighten you as to what those are and show you how to think about it more professionally and more quantitatively and systematically, basically.
Yeah, that makes a lot of sense. And a lot of, people will kind of naturally think, a lot of newer traders will think, well, why can't I just copy the person who's making all the money on a desk? We see this at prop trading desks a lot. Why can't I just shadow trade the top trader and do the same thing? Well, the styles are a lot different. And also, it's one of those things, like when it's your idea, you have all these concepts of like, this is not looking right, or at this point, I don't want to be in it anymore. And you can make those split decision kind of actions. Yeah. If you're just shadow trading, it's not sustainable. I mean, you'll never perform as well as the underlying trader, and you'll never know.
Yeah, I mean, I totally agree. The split-second decisions are a lot easier to make if you're the guy who came up with the trade and the idea, and you know why you're in it, right? But really, what it boils down to is how much work are you willing to put in? Like, do you want to learn to trade, or do you just want someone to make money for you? Because if you want someone else to do all the trades, then just give them the money and they'll run it for you, right? There's no point you copying the trade. Just give them the money. They're probably running a fund anyway, and they'll make you your returns, and that's fine. But if you want to learn to trade, then you've got to live and breathe it and understand the dynamics and understand how it works. And that requires putting in some work and some graft, right? But it's quite rewarding when you do it, because once you start to understand and you start to have an idea, think about the implementation, choose the implementation, and it works, and you monetize it, that's quite an exhilarating feeling, and it's quite addictive, and you want to keep doing it, basically. Yeah.
Love it. So last question as we wrap up here. You're running your business, you're still trading your own book. What do you do for fun? How do you, get your mind outside of the trading world and do other things?
Yeah, I mean, I'm a father, so I've got two young kids, 8 and 5 years old. So they keep me very busy. So any spare time I have, I'm hanging out with them, playing in the garden, messing about. And they're just a really great way for me to reset and kind of get away from the market and just kind of, take my mind off things, really. And I'm a very, very strong believer in, I'm quite lucky at this stage in my life. I'm 42 years old. Quite lucky at this stage in my life to be able to have a flexible job in terms of hours and not work for someone else. So what I think a lot of dads, especially in finance, but probably in every industry, right? But I obviously know a lot of people in finance. A lot of dads just miss out on their kids' childhoods, right? So when the kids are from 0 to 10 years old, the dads just aren't around because they're busy working and trying to make the money, right? To put them through private school or whatever the hell it is. But then when they're done and they're retired, they come home and the kids are like teenagers and they don't really want to hang out with them anymore, right? So I'm quite determined to be there when the kids actually want me around. And that's kind of what I am now. Now, that doesn't mean I've got all the time in the world to just mess about with my kids all day long, because I'm building a business and that requires a lot of time and energy. But what I am lucky is it's flexible. I can work till midnight if I want, and I can take the kids to school. and I can take a break when the kids come home from school, and I can hang out with them and have dinner with them and stuff like that. So I can choose my hours because I'm running my own firm, and that I think is a really it really empowers me and makes it a lot easier for me to have that work-life balance.
That's fantastic. You heard it here first. Imran spends the weekends playing video games. Just kidding. Guys, thank you so much.
No.
Thanks for tuning in. Imran, thank you for coming on the podcast. And remember, find edge, capture alpha, and slang size.
Thanks, man. Take care.